Builder Community, Territory 3, welcome. Just double checking for those that you saw my disaster a few webinars ago that we are not on mute, so we are live and broadcasting to you. Great to see you all, virtually speaking, and welcome. I'm very excited about this webinar. I get excited about a lot of the webinars, to be honest, but this one probably a little bit more so for a couple of reasons. Andrew Simmonds, welcome.
Thanks, John.
Live in real life. Thanks for the convenience of being in Auckland today. And Andrew and I go way back, for me, to the beginnings of startup land for me out of corporate world. So I'm really keen to sort of relive some of those elements and hear Andrew's reflections. He's had a, what would you call it, a hiatus, a sabbatical?
Yeah, I had a bit of a rest and recharge, and
he's had a bit of a rest and a lie down for a couple of years, and he's back, and it's very exciting and great for all of us, I think, because just so much value to add, and he'll tell you a little bit about himself in a moment. But first, the housekeeping side. We're going to basically drive this conversation from some prepared topics, but the main thing is that you as the audience get what you need to get out of this as founders. So fire the questions into the Q&A. I am on checking that we've got those questions in our line of sight. We'll take a break at minute 30 or thereabouts to make sure we've got the questions, and we'll make sure that we answer all those questions in about 10 to 12. We will do another check-in just to make sure that there's any burning questions you've got, but please put them in the Q&A, because the chat, lots of people say hi and do stuff, and they can get lost there. So if you want them answered, Q&A is the place. Thanks to our sponsors, New Zealand Trade Enterprise, Amazon Web Services, been helping us with some great founder dinners recently, and K1W1, Jasmine Investments, Vendor Management, who've been with us right from the very start. So that's the formalities, mate. Welcome.
Thank you, John.
I was about to change lawyers again. I was in the chemist warehouse, and then you rang me and you said, I'm back.
Did that happen, or did we just bump into each other on the street?
No, we bumped after that, after the chemist warehouse. We were going to be up the road. But, tell us a little bit about the journey, and then I'm going to dig into really your thoughts along the way. But I think for the audience, some of them are quite young, actually, yes, a little bit younger than us. A little bit about yourself. Yes. Okay. And where you've come from, and then we'll wrap into it.
Sure. Well, shall I go right back to the start as to how I got into this sort of interested in tech? Yeah. I'm 56, so okay. I was at school in the 80s, in the early 80s at high school. I'd always been interested in, well, like most kids of that age, any sort of digital technology. This was the age of sort of Space Invaders, really, when they got on the scene. And so anything that was digital, like a digital watch, a calculator, was just a huge attraction to kids of that age. And it was a novelty even when I was 10 or 11 to have a calculator, and one calculator in class that somebody had managed to steal off the parents. So really, for as long as I can remember living in New Zealand, I've been gravitated towards things with a computer or a digital screen. And that led me, I think I saw my first Apple computer when I was in Standard 4 and got involved with a little bit of, programming of that with punch cards.
Oh, wow.
And bought a Sinclair ZX81 and tried to learn to program that on 1K memory, and then trying machine code, which was when I realised that I probably wasn't going to make a career as a computer programmer.
I was going to say, you're not a programmer.
Yeah, I know. It was quite obvious I was not going to succeed at that. But I really, from that age, I just taken every chance I have to just do things with computing. I did a computer science paper in my law intermediate uni. I wrote my honours dissertation on computer crime. And in my career as a lawyer, every time I've had an opportunity to work on something involved with technology, I've grabbed it, I've chased it. And that ultimately led to me making a case for being a partner at Buddle Finlay, based on turning Buddle Finlay into the Gilbert and Tobin of New Zealand, a firm that was really focused and the leader in tech. That didn't really happen. But that strategy did lead to me meeting Sam Morgan, meeting people like you, starting to get involved in that more entrepreneur-led side of commerce in New Zealand, which as a partner in a big law firm actually was terrifying, actual real people doing real business, as opposed to getting doled out work from big corporates. But, you know, it was terrifying, but also very exciting. And that led to me working on the sale of Trade Me to Fairfax back on 2006. And shortly afterwards, I ended up leaving Finlay with Victoria Stewart to start Simmonds Stewart. And we initially focused a lot on tech, but also general government work as we had to do to pay the bills. And that ended up with us pivoting to focus exclusively on tech. And that business grew with us as the sector grew in New Zealand. It's become a bigger and bigger driver of economic activity, and that firm and other firms focusing on tech have just grown. So to this extent where, you know, for the last 10, 12 years, I've been lucky enough to work exclusively in that sort of sector.
You've been very humble. I'll blow a little bit of smoke up your stack and say that, you know, arguably, in my opinion, you were, up until your little lie down, you know, the preeminent startup tech lawyer, just because of the experiences you've been, right from that amazingly inspiring sale of Trade Me, and all the things that it itemised. And so the audience today, mate, as we get into the number of it, because we really want to be pithy with the time we have with you. And look, if you've got some specific legal questions, like, yeah, we're happy to answer those. But I think the real opportunity here as founders is to sit and sort of do a bit of a deep dive into the human side of it and say, you know, to you as someone who's seen so many of these entrepreneurs, right, from Sam.
Well, you, I mean, I met you before I met Sam.
Yeah.
I think you were the second SaaS business that I've been involved with. And I think I was able to make some slightly sensible comments about what terms and conditions an application service provider business might have then. So it wasn't called SaaS then. No, it was called application service provider. So I had some slightly sensible comments to make because I'd met somebody before you.
Yeah.
But
and so that's the, you know, and so if you want a timeline, that's way back into 2000.
1999.
In the late 90s. So, you know, you've seen founders. Yes. Most of the audience are founders here. Yes. You have been an investor yourself.
Yes.
And you've worked on that side, you know, so sometimes your client is the investor, sometimes your client is the entrepreneur, is the founder. I just wondered if it was possible for you just to give us sort of 2 to 5 minutes on, you know, your view as a close kind of supporter, you know, critical supporter of the ecosystem, about what you've seen, about the commonality, I guess, of, let's say, the first deal, or working with us at Sonar 6 back in the day versus today. You know, what's the same, what's different? How should founders think about the legal context? And you made some points earlier about the fact it's not actually just legal that underpins this, and just give us your thoughts on that.
Yeah. Well, the first thing I'd say is being a startup founder, being the founder of any business or starting any business is incredibly hard, John. For virtually everyone I've met, I no matter how sort of overnight the success of business is, usually there's an incredibly hard story behind it. There is the occasional example that I can think of that hasn't been like that, but I still want to find out more to actually find out how hard it was that they've just been able to cover it up, you know, because they're awesome at presenting themselves. And I think the biggest things that people underestimate when they start a new business is how emotionally hard it is, how hard it is on you in terms of anxiety, stress, doubt, and uncertainty, but also in terms of personal relationships. So if you're a sole founder, that's difficult because you don't have anyone else to lean on, and you need to find other people to create a team that can support you. Otherwise, that is very lonely, and you end up, I guess, going over a lot of ground or trying to do things or work out things that people with greater experience than you could have short-circuited for you, but also could have taken away some of the doubt, uncertainty, and worry for you, because a lot of, you know, most situations or most things have happened in a similar way before, but also interpersonal relationships with the people you work with. So one of the things that I see as a common factor of startups failing or business ventures failing or coming into difficulties as time goes on is actually things not working out between founders. that's one of the more common threads I've had. I mean, yeah, okay, a common thread is great idea, time is too early, or, you know, or bad idea, or poor execution, or those sort of things. But actually, it's more people oriented than that. Often it comes down to the fact that it's really hard for, you know, for 2, 3, 4 people to maintain a similar level of energy, a similar level of contribution, and a similar level of direction for even a short period of time, let alone the months, years, sometimes decades that are required for a startup to be successful. And of course, people's life circumstances change. So it may be that you're in a very, you know, you're all working really hard, and you're all motivated, and you're all contributing the same amount, and you're all as brilliant as each other, or not. But it all, you know, you're all making an equal contribution. But still, it only requires one person to have a relationship breakup, or a sick family member, or wanting to move overseas for some reason, or some other externality, and that, you know, even in a perfect team, those things tend to get upset. And when you mentioned to me when we were talking before, John, you couldn't think of a startup where the founding team had stayed together, and I can't either. I can think of startups where you think of a cohesive founding team, but it's kind of because, as you put it, the fourth Beatle, you know, or the fourth, fifth, sixth, seventh, eighth Beatle have just been kind of written out the story.
Yeah, and it's, you know, I think it's something that, you know, there's a lot of people on here, almost arguably all of us, you know, conscious of raising capital, either have done it or thinking about the next one and so forth. And I think one of the things why I want to just keep unpacking this piece is because in the early stages, certainly, a lot of the investor due diligence, and I'm interested in your view on this, is really around how those people work together. And kind of doing a bit of a risk matrix of how they're likely to work together in the future too, right?
Yeah, I think the due diligence, when I started out in this, the due diligence was very much focused on like lawyer M&A due diligence. So you go through and review all the documents and make sure the clocks, you know, sort of the something or other were ticked, boxes are ticked. And I think you're right, that's now not done by lawyers very much on the smaller rounds. You know, the investors go over that stuff, but yes, they're very concerned about the cap table to see how much equity is allocated to the people that are driving the business and that are most important to the business. And they're very concerned to make sure that the people that are really important, the key founders or the key people, have plenty of equity, and that contingencies are dealt with appropriately if someone important leaves, not so much to be mean to them or to punish them if they leave, but more to make sure that you don't end up with a situation where a founder with 20% of the equity leaves, and that equity is then effectively kind of lazy. That it is not working to take the business forward. And I used to be quite skeptical of investors' desire for founder vesting, but I came to the view, you know, thinking about it more and also looking at US guidance and practices, that actually it's a really important topic for founders even before investors get involved, because usually if there's 2 or 3 or even 4 of you, 1 or 2 people will drop out quite early or stop. You know, they can't financially afford to keep on working full time, and they've got to go and have another gig to earn the money. Yeah, you have to have some mechanism to reduce their shareholding that you've agreed beforehand, or you have to be prepared to have that conversation really quickly to find a way to do it in a positive way. Because otherwise, if the founders who are working hard in the business have the same equity awards as people who are not working hard in the business, it's demotivating, and it actually does make it harder to attract investment. So I think, although I was to say, you know, Suze Reynolds would say, Andrew, you know, you had a cow about this back in the day when we first suggested it. I'd have to admit I got that wrong. But and I get things wrong quite often, probably.
Sorry, we just stopping there. It is recording.
Yeah, we'll wipe that in the editing. There is actually often an alignment between what is good for founders and what is good for investors, because investors will make money ultimately if founders are highly motivated and make lots of money. It can be difficult to get that balance right sometimes. But
this is the bizarre thing, isn't it? Because you know, with the benefit of hindsight, us being a little bit more mature now, you look at some of the debates and the challenges and the stress and the friendships and the relationships lost. At the end of the day, the whole organisation potentially suffered. You know, everyone suffered because the value was never created, because the thing imploded or it didn't happen. And you can never say, you know, definitively that if that sort of thinking had been a little bit more constructive and perhaps a little bit longer term, because no one gets anything until there's some sort of exit event, right? And then a lot of the stuff that we see is founders sort of, as you say, having another event and saying, look, I can't contribute as I did because I've run out of capacity mentally, you know, other distractions in life.
Often,
And they start saying, well, now I want out of it. So this is where the V word comes in all the time about, you know, defining what value's been created at certain points before someone actually buys you, because the value's so hard to actually define. I mean, I'm going to get you to put two hats on around this as we dig in. It's like, firstly, as a founder, either, you know, so, you know, first time raising money or you know, looking to the next round of money. What are the common things that you would say on the postage stamp about the founder view? And then I'm going to ask you the same thing with the investor view head on, that you would recommend in all cases thinking about before you sort of start the strategy, go to the table, and then I'll flip it around from the investor side of things so we can find the common ground.
That's a lot of questions or a lot to cover, and I'm not very good at being succinct. The first, I'll step back a little bit. The first thing is that there's lots of information online that founders can use to educate themselves about expectations and legal arrangements that come with investment, but also all the things that are useful to do to have things reasonably tidy, if not perfect, you know, so that you are able to go forward to get investment. And you know, and Kindrick Partners has got an awesome library of templates, and they have founder vesting agreements, they have shareholder agreements, constitutions that founders can use, or at least, you know, with their pretty safely with their startups, but also can use to educate themselves on what is kind of good practice or best practice, because there's a lot of guidance within those documents about what the variables are and what they're intended for. There's other materials online, and there's plenty of guidance in the, you know, in the US as well, but sometimes a little hard to translate that US guidance into New Zealand because their terminology and document structures are different.
A little bit dangerous too, because different classes of shares and different sort of stack and that sort of thing.
We're trying to create the same stacks in New Zealand, but the language is different, and it gets hard. It gets a bit hard to translate, and also the tax situation is different. So things that work in the US from a tax perspective don't work here. And I should say, one of the reasons why it's hard to true up this stuff later is tax. So if we could just give the lead founder another 25% of the shares in the company because of the extra value they've created, well, actually often investors would be happy to do that, you know, to reset the cap table before an investment round, but you simply can't because it's disastrous from a tax perspective. So in New Zealand, it is necessary to try to address vesting and readjustments of shareholdings before you've had a value event. Once you've had a value event, like an investment, an external investment, it gets really difficult. And so you're doing yourself a favour if you tidy up that stuff or have agreement on that stuff before you get investment. I think having board advisors or directors or founders or people involved with your business that have got experience in going through the investment conversation, that's really important. Because if you haven't done it before, it's a steep learning curve. You can short circuit it by having people that are involved. I think imagining what your cap table is going to look like, you know, your percentage shareholdings for your core founders and what you've put aside for ESOP and any friends and family investors, and what that's going to look like after investment, and how you think your investors are going to perceive that, and how the next round of investors are going to perceive that is quite important.
You've also got to write sort of a headline that's 3 or 4 steps ahead to make sure that
it's going to line up. You really do, because the feedback that I've seen often from US investors looking at New Zealand companies and Australian VCs really, is they look at the cap tables of New Zealand companies and say the founders don't have enough. Yeah. They've issued shares on a friends and family round or to angel investors at too low a valuation. There's too many founders, or there's founders who aren't participating anymore. And a US pre-seed round might only want 25% of the company for putting in, a couple of million, which would give you a very high valuation. But they're prepared to accept a relatively small shareholding for the money they put in because they want to see the founders incentivized to get to success. But if what's left is the founder only has another 25% and the rest is friends and family or angel investors, they're not going to be interested in that. They're going to find that quite challenging.
And it's sort of coming into the investor side of that, around more mature investors who have put a few deals down and seen a few exits and reflected on what actually worked.
Yes.
I mean, is the other scenario around why perhaps the US investors are more comfortable and more intentional around lots of equity for founders? Also because the things that they've seen work will always need more capital faster. So there's an opportunity for them,
yes,
as a participator and making sure. And I think this is a thing I would suggest, interested in your perspective, that founders think about the type of investor as you're doing it for the first round. But the only certainty is if you knock it out of the park, go faster.
Yes,
you're going to need capital faster. Yes. If things don't go quite so well, you need capital faster. Yes. And ideally, the investor base you have, you want to be able to kind of mainly tap into that to follow on.
Yes,
because it's a huge amount of effort to pitch other people.
Yeah, I think that's right. The US VCs that make seed or Series A investments want to take this through to a Series D, Series E, IPO, $billion sale, and so they want to see a cap table at the start that's going to go the distance. And okay, founders are going to get diluted down to 10% each, or actually 10% in total by the time it's $1 billion, but that's still a lot of money. Or if you've got a tremendously successful company, it might be more than that. But it's a bit binary, I think, for the US VCs. Like they want to have a percentage of a really big company after a whole lot of investment rounds, or they're prepared to pretty much write it off. I mean, okay, any intermediate outcome, they'll still pursue that, but they set the valuations of their initial investments with the idea that this is something that is capable of going the distance. So if the New Zealand founders have given up too much equity to get to that stage, it becomes difficult to bring in US investors. I mean, some of it it's not so much a quality of investor issue, or that it's just a mismatch of business plans, I think. So in New Zealand, companies that are funded from here generally are not going to get to $1 billion exit. I mean, some do, but the way that the amount of capital that's available to fund loss-making investment in massive growth is not big enough generally. So New Zealand investors don't have the luxury of looking forward or investing in things that are reliably, that there's a possibility, a believable possibility they're going to get to $1 billion or whatever. So they start with smaller valuations, and the steps that come after that on that trajectory are inevitably not as much money going in, because the plan isn't as aggressive. So I suppose it's not so much entirely a different that US investors are better for founders or not. It's a different trajectory that you're on. So if you've got a company that is focused on selling products into the US, well, ultimately you might want US investors and they're going to want to invest in a very aggressive sales growth.
So do you think, because we had a founders dinner on Tuesday night, and a very small group of people really putting runs on the board, and we were all talking about fundraising in the context of hundreds of no's. And I guess, what we're talking about here is, my question to you and the provocation is, do you think from what you've seen, we're being smart enough about founders based on what you've just seen? Smart enough as founders actually identifying the group of investors based on the sort of mentality. We've had Dave Ferguson through here recently, got a company called Neuro in the US, pretty much a US company. It's raised $2 billion US, $2 billion for a game-changing autonomous vehicle company.
Right.
That clearly investors see a wide enough, arc to, the return on $2 billion of early stage investments.
Yes.
Some of our ideas and the way we're pitching them just sort of too, and Peter Beck's got a very strong view on this. Are they just too, we mismatched at the beginning of our investor search process around these sort of layers and the way people look at them?
Well, I think sometimes, but a lot of our businesses are well suited to New Zealand investment. So, we're really good at SaaS in New Zealand, and a lot of those SaaS businesses can be grown successfully from here with New Zealand investors. New Zealand investors have a lot of expertise in that, and they can attract really good exits. Occasionally, some of these software businesses have amazing exits, and a company that I was involved with, the Rands Geo, which became Sequent, the Pancaro, who I introduced, into invest in that company when I was the chair of that company. Pancaro, was able to attract KKR to buy half of that company and do a big investment in that then bought out a massive French company, and that sold for 1.4 billion US.
It was a billion, huh?
Yeah, no, it was a US dollars. It was over $1 billion US dollars. And I don't know how much of that 1.6 billion represents the effect of the merger with the French company, because that was of an equivalent size. But that company was highly profitable and on a growth trajectory, a great growth trajectory before Pancaro invested. It had had no external investment. The investment in that company had been funding from Callaghan grants, or the predecessor to Callaghan. Just incredibly smart people that have bootstrapped that company out of another company that had some friends and family investment. So it can happen that, I think, and then the difficulty is that if you start out small with a small investment hypothesis, you perhaps have to wait longer before you can get a private equity investor or a KKR or a big VC, because you actually have to produce some of those annoying things called EBIT, right? Profits, yeah. And then, Pancaro, then KKR back to, massive aggressive M&A backed growth strategies for that company. And Peter Beck's journey is different, but you could probably draw some parallels. So I don't think that it's our investors are wrong in New Zealand. There's just or that the model is wrong. I think we're really good at certain things, and these are the kind of businesses you've had success with, John, and that you've had success selling. But certain types of businesses, particularly if they've got an opportunity to grow sales in the US, then find a trajectory to get US investment early is probably a good idea. The Nereid, Guy Haddleton, Kiwi investor, but he's an international businessman. He flipped that company to the US, and at some stage you'd imagine that company is going to do a massive raise over there. Anaplan, his prior company, that got investment in New Zealand at what, Sam Morgan was an investor in that company. He thought Guy's plans were ridiculous in terms of how much burn he was committing to, but Guy knew what it took to create a successful company in the United States, and he had the chutzpah to take those amazing risks and to take New Zealand investors on a journey, some pretty headstrong New Zealand investors on a journey that they were really uncomfortable with. So
ultimately very happy with.
Oh man, that was just an incredible story. And the interesting thing is some of the smartest tech in that was not by the US team, who are the main development team. It was actually by Bain Hollister and Co at Clearport. So I think sometimes there's a pivot point that happens because of an individual getting involved with a company. And I'd say with Iran's Geo, it was Sean Maloney stepping up from sales director to CEO, and that only happened because the previous CEO decided to leave because he wanted more certainty because of the earthquake situation in Christchurch. And the previous CEO was awesome. Yeah. But Sean just knew how to create an international sales and distribution network, and lots of other people made massive contributions. The technology was amazing, but that was the pivot point from going from a company that we had an offer to sell it for $10 million. So I took that company out to market because the these owners wanted to see what it was worth. We had an offer of $10 million from a mining software company. We turned them down because we said we can do better than that. And 7 or 8 years later, Sean had turned that into a $1.6 billion exit.
And I just want to keep.
You can't plan for that, sorry.
No, you can't. But there's some really interesting points there that I think as founders, it's just the technicality piece. Obviously, you need to have the legal advice and so forth. But I'm sitting here thinking that the time here that we've got with you is much more about the theses and the things you've drawn out by seeing so many of these scenarios. So, when we come to the T word in terms of talent, yes, that was a great example there. I think.
Yes, because Sean wasn't a founder, he was an employee.
Well, this is exactly my point. And so, if you're sitting thinking about your years doing this and the different founders that have been in front of you and the different executives you've seen, obviously, how do you begin to get real and have a process around yourself as a founder in terms of bettering yourself, and then also recognizing the point where the bettering of yourself is either not going to deliver a better CEO founder or that, and you're actually better to start then looking for, to the example you just gave,
yes,
new outside talent or potentially people that you've nurtured inside the organisation who actually might just be able to shoot past you.
So this is a really difficult topic, and it's almost a topic we could spend, and I'm sorry I haven't talked about legal stuff very much. Well, I'm going to divert slightly and mention some legal things.
We've given our folks the opportunity to put Q&A if they want legal stuff, but and sing out, folks, because this is your webinar, not mine. If you've got topics specifically you want us to cover, let us know. But I'm happy if the audience is happy with this.
So I'm going to quickly mention one legal thing, and that is get a relationship with a lawyer that's experienced in the tech sector and has experienced negotiating investment transactions early on. Try to pay them something for their advice.
Pay a lawyer.
Yeah, I know, it's a difficult conversation, but you can do a lot with free templates, and particularly the Kindrick templates. But also, you want a lawyer that understands what you're trying to achieve, that you can call when you when you're thinking about pitching to investors, or when investors have put a proposition to you, and trying to find somebody when you're at that stage is probably a bit late because that person's got to get up to speed with your business. So try not to expect too much for free. Most lawyers working in this space will give you time for free, but try not to overuse that because they end up getting a bit sick of you, or it's a bit, there's only so much time they can give you. Keep that for something where you really need it. But there are some really good startup law firms in New Zealand, or law firms with really good startup people. I mean, it's dramatically different than what it was when I started focusing on this area. So there's lots of choice. I would say that I think it's a worthwhile investment as long as, you don't let them just run amok and do everything for you. There's no point in trying to invent the perfect governance documents or sales contracts or that sort of thing before you've even got customers and before you've got investment. Try and self-serve some of that stuff yourself. One thing I would advise a little bit of caution about is when you get investment or an investment offer, your VCs or your investors may try to influence who your lawyers are, or they may try and get you to not have lawyers and just rely on the documents that are industry standard, that are signed off by their lawyers. And look, even if all you can afford is 3 or 4 hours or a couple of hours of an experienced startup or venture lawyer to look over the term sheet, that'll highlight for you whether there's anything in there that's a bit harsh, or you should look to negotiate a little bit. And sometimes at that term sheet stage, that's the most important time for some input. I've forgotten now I've diverted off what your question was, which was a good one. Oh, talent, yes. Talent.
Just the talent, yeah. When a founder should be thinking and looking at themselves in the mirror and saying, there's someone better to do this. So
I encourage founders or a lead founder or the main founder to try and be CEO for as long as they can, or as long as they believe that they're able to do the job. Because once you step down as CEO, you're vulnerable. It is impossible, or next to impossible under New Zealand employment law, to make a CEO redundant. But if you are any other position,
it's quite hard to get to be a CEO too. So I guess it balances.
Well, I mean, this is if you've got more than one founder, who do you give this advice to? So the problem often becomes when there's a founder dispute, you might have 3 founders or 2 founders. One of them decided, peeps, I'll be the CEO. It's no big deal. It doesn't really mean anything, but somebody has to be CEO. And then when there's a founder dispute, they're stuck with them because you can't make the CEO redundant. And if you try to sack them, then you're going to end up having to buy out their shareholding and pay them compensation. So
folks, if you think this is quite a brutal conversation for Legal 101, it's just because you haven't been in the scenario for too long. It happens all the time.
So, startups, unfortunately, are often the decision making in startups, particularly when it comes to who's in charge, is easy when everything's going well. But generally, it's not always going well. It's hard. And what can often happen is friction at the board level between the investors and the founders, and the investors and the lead founder CEO. And a conversation that frequently comes up is the founder comes under pressure to step down as CEO because the investors aren't happy and they want to put in somebody else. And that somebody else will probably be not one of the other founders, and it'll be somebody that the investors have worked with before. I have very rarely seen that as a recipe for success for a company. It's not necessarily that the investors are wrong about the founder not being up to it, but the founder is the person who's got the motivation to do the hard yards, to work 60, 70 hours a week, and that has the emotional commitment and drive to make it be successful. More often than not, when I've seen an industry CEO parachuted into these companies, the companies have just gone sideways, burned through the money, and then that's the end of it, and the founders are left to pick up the pieces somehow or other. So that it's difficult for anyone to push out the CEO. The time that can happen is when you run out of money and the investors say, well, we're not going to put any more money in unless you step down. And then there's kind of a game of chicken goes on with that. And I mean, I'm talking in a very generalised fashion. There's a guy, founders who've had this said to them that it's time for you to go, pal, by investors. What I often say to the founders is, well, if they're in the minority, they don't control the company and the other founders are against them. I refer them to a passage in the Twitter book where the current Twitter, what's the name of the current Twitter CEO? Evan, where Evan was told that by the investors over lunch, mate, or no, his lawyer over lunch, mate, no one likes you, and the end is inevitable. You can make it painful for yourself, or you can just fuck off, and because that's going to be the end outcome. I mean, I'm not paraphrasing it very well, but there is a passage in the Twitter. When everyone is against you, including the other founders, then in a dispute, well, then you probably should go, and it's about how you negotiate the exit. But look, I'm not answering the question very well. I think that founders should try to keep control of the company until it's obvious to them that there's somebody better to run it. And I think I probably, that's as much as I can say about that one.
Yeah, no, I think that makes a lot of sense. And and again, the reason that's sort of, for me anyway, in the definition of 101 is like thinking about these things, not too hard and too long, but thinking about these things early in terms of the terms and documents and stuff that you look at and go, oh, that's probably not too much to worry about because there's only 4 of us and we've got 500k, and it's very hard to unwind, isn't it?
Yes, it is. Yeah, I mean, bringing an investor is like a marriage that you can't get out of.
You can get out of marriages, I know that.
That's what I said. Yeah, so I know that as well. So it is like a marriage you can't get out of unless you can find another investor to buy out the old investor. And that's generally quite hard to do, though not impossible. So you do need to put some, you do need to put some decent effort into working out if this person is somebody that you are going to be able to build a long-term working relationship with. You have to be, I think sometimes I see founders get impatient or frustrated with investors quite quickly over the investor's desire for process, for understanding the detail of where the money is going, or challenging the founder's decision-making. So I think sometimes founders are too quick to get frustrated or to get into an adversarial relationship with investors. You've got to appreciate they're coming from a different perspective, and that they are going to expect to hold you to account. And in a sense, you are working for them in part. On the other hand, if you just take the mentality you're going to do everything your investor says and run the company they want you to, you're probably abrogating your own responsibility. And you're the person that's in there 24/7 and who's having to answer to all the other shareholders, to your family who lent you the money, and to your co-founders and employees. So I think you do have to be your own person. I think it's a difficult balance to make, but I do find myself, when I'm talking with founders who are getting frustrated with investors, trying to get them to see that other perspective. George, I just try and answer a couple of these questions.
We've woken the audience up. I mean, clearly, whatever it is that you've said is
what I'm talking about.
There's two ways of looking at everything, isn't there? I think is what we've said. So, Veronique has got a question for you there.
Hi, Vero. So do I think founders are too emotionally attached to the company and therefore an external CEO is being fresh thinking? Look, I think ideally founders have just got the greatest incentive to see the company through to success. I think everyone has to try to be self-aware and to understand where your limitations are, but it's possible to grow into a job. And I think it's up to the board and the investors and the co-founders to actually help the whole team grow with the job. And some of the best companies I've seen have been where that's all works well together. I think it's at a certain stage, yes, a professional CEO might be able to take something further, faster, better. And, Xero obviously is a great example where Rod stood aside a long time ago, but that's a long way down the track. Most of the time, for a long time, and even right up until exit, these companies survive because of the entrepreneurial grit and just sheer perseverance and insane hard work of the founders.
And to your point, what's in it for them really is being one of the most significant sort of drivers to keep going on it.
A sense of responsibility, John, even if the money, isn't stacking up. The founders are the people that are kind of Nelson at Trafalgar, standing there with the waves lapping over the boat, bailing frantically. So Stuart's asking how do you identify a good lawyer as an interview type process? Have you been involved in seeking investment? How do you verify their claims? Well, lawyers don't lie, Stuart, so there's no need to verify it. I mean, lawyers do take credit.
Just have to go off screen.
Lawyers will sometimes or quite often say they have done something when actually they were part of a team that did something. And look, if I, I've done a lot of my career, I've not known the hell of what I'm doing because I'm doing it for the first time. And, a surgeon said to me once, it's called medical practice. I asked him, well, how on earth did you have the guts to do a lumbar puncture for the first time? I said, well, it's called medical practice for a reason, Andrew. I just have to project confidence as I slam the needle in somebody's spine. But I mean, in New Zealand, we have the luxury now that there are lots of lawyers in many law firms and in boutique law firms that have had plenty of experience working on investment deals. As a founder, I think the question to identify is, when you're talking to a lawyer, is do they mainly act for founders or do they mainly act for investors? Because it tends to be one or the other. And you would prefer, I think you're better off to work with a lawyer who mainly works for founders. Not only because they bring a founder perspective to investment discussions, but also they're the people that are used to being company counsel and helping guide you on all these other things that you have to get right. So Dominic asks, what's your advice if a potential large investor wants a place on the board, but you don't think they will add any value? Well, how much do you need the money from them? I think a large investor has a reasonable right to see how the money is being spent and to participate in discussions in the governance of the company. It's difficult though sometimes because this is small business is personal. How the boards work is about personal interrelationships and how you work together and how you contribute together, and often that breaks down. So board members get angry with each other. So I guess I may have said, I didn't really get onto this at the start, but psychology, I find myself being a psychologist or an amateur psychologist a lot of the time. People in early stage businesses, it's really hard, it's really stressful, it's really emotional, and their decision making is often driven by emotion. Now, when you've got professional venture capitalists involved and private equity, their decision making is driven by numbers and by commercial rationale. But when you've got private investors, non-professional investors, which you often need to get yourself along the way, it's not the case. The emotion is a lot more, and people's psychology is a lot more of it. And of course, founders are usually emotional about their companies, as Veronique's, and it's hard, and you wouldn't do this sort of stuff unless you had a particular psychological makeup. And I think you have to work on yourself. You have to recognize when try to recognize when you're being emotional, try to take time out and avoid responding when you're emotional, trying to recognize other people's emotional drivers in conversations. And that's hard work. And having people around you that can coach you and give you perspective on that. Like, I'm an emotional person, and in my business and in the things I do personally, I get overly emotional and I can't help it. I'm better as a lawyer at being able to give people advice, and help them moderate their decision making and to highlight to them when they're being driven by emotion. But I can't say I'm great at it myself. So I think that's where, my personal dealings. So
I think we will sort of, learn more about that over time, don't we?
Yeah,
in terms of, what's going on for the other party. And that probably be something I would say about understanding the level of professionalism of your investor, because there are some tricks and traps around how the VCs in particular work in terms of what they're expecting from their investment and how many of them they're actually, which fund it's come from, how much more, so there's a lot of questions, I think, for investors, and yes, there's a lot of resources online to say basically, where am I at in terms of how this investor is viewing me as an opportunity, and where are they at in terms of deploying their capital in their particular fund or their thesis.
Yeah, some founders I meet put quite a lot of effort into their own emotional well-being,
Mm-hmm.
and I I notice that those people often have greater longevity because they're able to manage the adversity that comes their way, and they find ways, or they perhaps have a few more tools to try to manage the inevitable conflict that arises.
It's not eliminating it, it's how to actually manage it better.
No.
Dominic's got another question, and then we'll go to Dan probably.
Can I recap existing investors even if they don't want to sell, e.g. if a VC firm comes in and wants a larger share than we have available, just a hypothetical? I mean, that's a real situation that happens. It may be that you need to recap often when you've got particularly an overseas VC, they will look at your cap table and say, look, it doesn't work for us. Those founders or ex-founders have got too much. Those board advisors, they've got too much. Those friends and family or angel investors have got too much. And unless you can restructure this, we can't see how the cap table can work for us. Or we just want you to have more. We want this founder to have more. It's really hard in New Zealand because tax gets in the road of it.
Sometimes some gnarly clauses from people early in terms of their rights, or
sometimes, but more often it's just you issue equity with the best of intentions, and it's difficult to put it right. It's difficult to change it later. I think obviously having vesting agreements in place with your founders can fix some of that, but sometimes it's just necessary to have a hard conversation with everyone, being upfront and honest, and not to attack people and diminish their contribution, but to find a way forward so that you can restructure the cap table. Sometimes it's necessary to buy out some of the early investors or early contributors to the company. That involves finding a price that they'll accept, and that doesn't derail the whole deal, because generally speaking, in the scenario that Dominic's talking about, the new investors won't want to buy out old investors or founders at the new pre-money. But it might be that it's possible to get some money to buy people out, at 50% of that. And I've actually done that myself with Code Lingo that I was involved with Jesse Meek, a Dunedin company, that awesome guy, an awesome idea and software.
Yeah, Jesse was on a couple of weeks ago.
Yeah, I helped Jesse find some initial seed investors, and I put in a little bit of money. And when he got offshore investment, they didn't want us there. And Jesse, they wanted Jesse to have a bit more equity, so we sold to another investor. I can't. It's something like that. It was quite along those lines. And me and the other people that I brought in, we're happy to do that. We got a little uplift, but we realised we weren't adding the new investors didn't see us adding value.
Yeah. So possibly is the answer to Dominic's question.
Yeah, having good relationships with people is the key to that. So Dan asked, in my experience, are many law graduates actually interested in the tech space, or are they generally much more interested in property, wills and trusts? Well, I don't think any lawyer. Well, I'm exaggerating. I don't think many law graduates are sitting, or law students are sitting there really being excited about property, wills and trusts. But when you're at law school, you don't have any idea what lawyers actually do. So a lot of lawyers at law school are off doing international law or law of human rights and this sort of thing, which aren't actually on the whole jobs that exist. Certainly not in New Zealand, or there's a very limited number of jobs. So, Kindrick Partners, or Simmonds Stewart as it was then, was putting in quite a lot of effort at Auckland Law School to expose a bit more about what tech law is about, and therefore what commercial law is about. So Lou, we are a couple founder. I sometimes get angry with my partner about the company and doesn't agree with him with his options. I worry that will make the company in a bad situation. What is your suggesting? So I read from that this is a life partner
and business partner.
I was going to touch on this. I have been through that myself, and I'm out the other side of it. So life partner businesses or founder businesses can be powerful because you've got two people highly committed to the success of the venture, but I think it often ends up with divorce because startups are really, really stressful.
Yeah.
Also, financially, it's putting a lot of risk in one basket, and it is sometimes necessary in startups to work without any cash coming in. And if both of you are in that situation, or if time gets hard and you have to take a pay cut for a while whilst you're looking for new investment or something like that, for both of you to have to do that, that's very challenging. So I think I would generally advise people to be cautious about having a long-term plan to be in a startup together, and perhaps having an idea about how you might backfill one of your roles when the company is far enough along.
I think in a structure too, when the arguments or the debates, which you should have in building a business, right, about to get to the best path, you need to have some challenge, but obviously that's difficult when you then go home.
Yeah, and keep on talking about it at home.
And, you know, you were right and they were wrong.
Yeah. Also, investors are a bit skeptical. They like to be able to deal with founders individually and not as kind of blocks, and they perceive a life partner team as a kind of a block that is difficult or can be difficult to deal with. You know, if the investor's not happy with the performance of one of the partners, it's very difficult to raise that with the other founder because it's their life partner. So I think investors are wary of that, probably rightly so. So I'm not saying it can't work, but I think it has some challenges.
Huge challenges, yeah. Kudos to you for going at it that way. It's not an easy path, I know. Another question here, folks. We're basically just about out of time, so if you do have any last minute questions, it's your chance to fire them in. Veronica's got another one here.
So do I have any advice on the perfect composition of the board? Who would you recommend on the board for a startup? Any specific type, person, profile or experience? I think it's good to have somebody on the board that has been through the journey before, particularly somebody that's, if capital raising is on your horizon, has had experience with that. Being able to attract capital is often about the people you've got involved in the business who capital providers are confident of or who have track record with. So obviously, you know, if you can get a super clever, super well-connected person like Don Holt on your board, that's awesome, because that gives investors confidence, provides contacts. But I think if you go too far with that and kind of have a celebrity board, I think sometimes that puts people off because it looks like you're trying too hard. And it kind of, I don't know, it starts to make your startup look like a house that's been built on the block or something, you know. It's sort of built for publicity, not for performance.
I think we've been in a number of scenarios together with this sort of challenge, and I think one of the key things is the dynamic. So you can have the most expert people, but you do need to think about how they're going to work together, because if you've got one person who just dominates every decision, or then that creates frustration. People tend to say less, and then you're actually not getting the leverage of the skills and the experience of the people you've got. So how they actually operate together, and I guess that comes to the point of a chair, doesn't it? It's like somebody who actually, you know, it's a critical role to actually curate that conversation.
Yes.
And make sure all of those voices you've invested in and recognised talent actually make contributions to the decision.
Yes, when you've got to a certain size and you can attract a chair who's really good at pulling that together, that then takes some of the pressure off the founder as CEO as well. A good chair who works with the founder, who can also bring the board together to get the best contributions that can be really powerful, but it's not an easy thing to find, and it's finding the right board members is still a bit of a challenge. Maybe this is a startup idea of a way to profile and to rate board members or something in New Zealand, because it's very opaque at the moment. David Bremner, hi David, you've got a great question there. In the US, companies are much more likely to have legal staff within the company, probably to do with the scale of the organisations, but also a lot more custom contracts. Yeah, I mean, the US, things get legal a lot more in the US because they sue each other a lot. Yeah. But also the companies have a lot more scale. Tech companies in New Zealand that have got some scale do have in-house lawyers. And I think in New Zealand, we're lucky in New Zealand that there's lots of really good lawyers working in law firms and independently that have a lot of international legal experience that can do a really good job for New Zealand tech companies, drafting T's and C's, privacy stuff, and contracts, distribution, and all of that. Our legal industry is really high quality, and that's because so many New Zealand lawyers, senior New Zealand lawyers, have spent a lot of time working in London, New York, and have brought all that experience, best practice, back to New Zealand. So I think New Zealand startups are actually spoiled. That the standard, say, in Singapore is way lower.
Yeah. Folks, we're out of time, and I'm always conscious of finishing on time, but I know there's still a good number of you here. Andrew, are you happy to answer the questions that are remaining?
Yeah, I'm happy to keep going.
So, folks, thank you very much. If you have to dash and you've slotted us into your schedule, but thank you, Andrew, for those that have got those questions. We will just keep going until we have finished the last three. James McGeorge.
So James asked, how much input or oversight do you think is healthy for a board to have on contracting? Should boards sign off on contracts that are over a threshold of AIR or have some assessment of legal risk? It depends a bit on the size of the company. I think standard customer contracts that have been signed off by a lawyer, or that you've created from some standard legal resource, the board doesn't need to see. But I think the board should be across anything that it has the potential to limit your options in the future, or that might impact on future liquidity or valuation discussions. So anything with the word exclusivity in it. So I'm particularly cautious as a lawyer about distribution agreements, partnering agreements, that sort of thing, that tie a company into a particular sales channel or development channel, or to a particular customer relationship, or potentially lock yourself out of markets. There might be quite a bit of money associated with those things, and it might make sense for you at the time, but often they are quite unattractive to acquirers, particularly industry acquirers, because they want to be able to sell your products through their sales channels. So I mean, we've had experience of this, John, with partnering, companies I've worked with you on, partnering with industry partners, and it reduces optionality for the future. Yeah. It's not to say you should never do that, but I think the board has to be across anything that's going to impact on your commercial freedom in the future. Somebody has said, what should you look for in a chair? I think somebody who's good at building consensus, somebody that has commercial experience, ideally in your domain. So, I mean, one of the hardest things, well, the hardest thing, most important thing to achieve in a company is sales or revenue. If you're getting revenue, if you're growing sales, growing revenue, I mean, obviously there can be unprofitable revenue, but let's just say if you're able to attract sales, you've cracked one of the hardest things, and particularly if you've got a repeatable sales model. So a chair that can contribute to that or mentor the chief executive or the founder is awesome. And look, transactional experience, you don't have to have the chair be the person that fronts investment discussions. That can be anyone on the board or the founder. So I think that the most important role of the chair is somebody who has a good relationship, can build good relationships with the founder, that can support the founders or the CEO to do the job well, and that can contribute in some area to the go forward, to the strategic goals of the company, be it sales or investment raising or M&A or something like that.
Yeah, 100% agree. And I think having been on both sides of that, a good chair will give you signals early, such as, my style is to spend some time with you between board meetings, pretty regularly catch up, and just have a lot of unformed time as well as in the formal side. And generally they'll be saying that they're going to do that with other directors as well, just to keep your actual meeting times and the time to come together, to drive towards consensus, and also just to be well prepared and well versed about what the real challenges are outside of what's written on the agenda.
Yeah. So Ruben asked a question, which you've obviously got an interesting business, Ruben, because I've never been asked this question before in New Zealand.
It's very long.
So over the life cycle of the founder role within a corporation, let's say pre-seed to Series C, how often do you see litigation and involving the company, and how great a role does corp counsel tend to play versus outside counsel on litigation specialists? And if one's in a contentious industry, say cryptocurrency, reg tech, legal tech, what would you say it's sensible to look for in terms of litigation experience? So I guess the first thing I'd say is it's best to try and avoid litigation, right? And I think I'm a commercial lawyer, not a litigator, so I'm a lover, not a fighter. I try to get to yes. I can, be quite tough in getting to yes, but I've actually never been involved with a client in issuing proceedings against anyone I think this is right, to get to a resolution. Definitely talked about it, and I think once or twice my clients have been sued. One was very, very painful. If you are in a contentious industry, you have to invest in compliance. So fintech is a good example of that. If you're in an industry that's involved in selling consumer finance or involved in consumer finance, there's a lot of compliance obligations that go with that. You probably have to invest early in getting a fintech lawyer in-house. That's not easy to do because they're thin on the ground. And you might have to spend quite a bit of time searching for a fintech expert or a financial services expert that can work with you to apply New Zealand's financial services regulations to get compliance. New Zealand is not a litigious country. And since 87, the stock market crash, the funders of litigation, or the people that pay for litigation, insurance companies and the like, have really had a collective effort to steer the businesses away from litigation as a way of resolving commercial disputes and as a way for conducting insolvencies. So more and more commercial disputes in New Zealand are settled out of court, and that's to the extent that the New Zealand High Court has been moaning that New Zealand lawyers are not doing enough to bring interesting cases to the High Court so that the New Zealand's High Court judges can stay current on the law.
High Court wants to work harder.
No, the High Court wants more cases, which I just laugh. We want less litigation in New Zealand, but I thought that was really interesting. So we also don't like fighting in New Zealand. We really shy away from disputes and we try to solve them short of litigation. Australians are more aggressive. Look, having said that, there are some really good litigators. You have to, the big law firms and barristers, if you're in an area that's going to need that kind of support, you're going to have to spend time interviewing law firms and interviewing barristers and learning from experience who's good. One of the I mean, this is perhaps a little plug for what I'm doing. I've started out and started working as a new law firm, Simmonds Law Limited, and that's effectively me as a sole practitioner. One of the things that I want to have working with my clients is litigation support, because occasionally you do get involved in litigation.
Yeah.
You also want employment law support, because employment claims are probably one of the most common things in any New Zealand business type of dispute you have to deal with. Property and IP. So I've partnered with the mid-size, large law firm called Anthony Harper that's very good in that mid-size litigation field, as I want to have that support. And before I finish my legal career, I do want to be involved in suing somebody on behalf of a client. It's horses for courses, really, and you have to find a law firm that's a fit for your needs.
Andrew, thank you. You've been very generous with your time. We've gone well over. Thank you, folks. I know there's still a number of you on. Really appreciate you tuning in today. I think there'll probably be a groundswell of requests for us to have you back, perhaps with another facet of this critical piece of building a business in terms of making sure you get your legal structures, advice, and the people helping you right. And so it's great to have you back in the industry again. And it's probably just the beginning of getting you involved in the Territory 3 community again, as you were fundamentally began it for us and did our legals for us back about 12 years ago. So thanks, everyone. See you next time.
Thanks, John.